Last week, New York once again became the center of a global financial threat. The big players of the money game began to worry that America may never be able to pay back its crushing $13 trillion debt. The New York Stock Exchange was hit hard.
It's been a roller coaster ride this year, it really has. We had great gains beginning of the year this spring, but they started to erode into the summer. And you're right, the gains have been wiped out over the last 2 weeks. Actually, as a matter of fact, on paper, the market has lost $2.9 trillion within the last 3 weeks.
The stock exchange is becoming more erratic by the day, leading to unprecedented unpredictability.
When I first started here, we had 3 minutes to execute an order. Now we'll do 10,000 orders in less than a second.
That means a market driven less by action and more by reaction. Even the big players like BlackRock, the world's largest money manager, are now in uncharted territory. Rick Rieder controls almost a quarter of their more than $3 trillion portfolio.
I think we live in a world now where data and information is so transparent and so fluid that you get reactions that are pretty extreme. You know, we've never seen movements like this before. I'll give you one good example. It took from middle of 03 to middle of 07, 1,380 days, almost 4 years, the equity market never went down 2% in any day for 4 years. And we're going up and down 4%. And one day we're down 6.75%. Never seen anything like this.
So what caused such instability? First, Congress couldn't agree on whether or not to raise the nation's debt ceiling. Republicans accused Democrats of letting the debt get out of control, and Democrats accused Republicans of dangerous political hijacking.
And it is time for the administration and time for our colleagues across the aisle, put something on the table. Tell us where you are.
They were saying, if we do not raise the debt ceiling, we're going to default. Now, what does that mean? That means if we can't borrow more money, we're not going to pay back any of the money that we've already borrowed. Now, what is that telling our creditors? That this is a Ponzi scheme.
Peter Schiff is the CEO of Euro-Pacific Capital, and he was furious at what he saw.
This is all about a self-imposed borrowing ceiling. But what we're telling our creditors, hey, China, Japan, if you don't lend us, if one day you get to the point where you don't want to lend us any more money because you think you've loaned us enough, we're not going to pay you back. That's what we told the world. We told the world we will only pay back the money we've already borrowed if we can borrow more to do it.
Congress eventually agreed to increase the debt limit, but with provisions. Those included $2 trillion in spending cuts, including from social programs, but no raise in taxes on the wealthy. Many saw this as Congress coddling the rich at the expense of everyone else. Economist and author Moshe Adler agrees.
People are debating of how to really give the bankers what they want, or how to revive the financial markets. We are not about the financial markets. The financial markets are a part of the equation, but a small part of the equation. We need to start talking about ourselves, okay? And ourselves, what are the rules of the game that the government can institute so that we can work and make a living and pay taxes. We want to pay taxes. We don't want the rich to pay for us. The only way to do that is to make the rich, to begin with, less rich.
All sides agree that the debt ceiling negotiations were bungled. And then, off the back of the deal, came the historic decision by Standard & Poor's rating agency to downgrade America's credit from the highest grade of AAA, investor speak for risk-free, to the lower AA+, bumping United States bonds a rung down from the few remaining AAA countries.
I think it's significant in that you finally have an established, respectable rating agency basically saying what should be obvious to everybody, that the U.S. government is not AAA. In fact, I don't think they downgraded them far enough. I don't think that we're AA+.
Then, immediately after the S&P downgrade, just when the world was expecting the U.S. Treasury to take a beating, there was a sudden rush on buying United States Treasury bonds. And BlackRock led the way.
When there's a disruption in the markets, there is no batting an eye, AAA or AA+, there's no batting an eye, we're going into Treasuries. And that's not changing. And we fundamentally believe the U.S. is a AAA country.
Well, I mean, that shows you how absurd it is. And you're talking about going from the sublime to the ridiculous. You know, what's going on is the dollar and U.S. Treasuries have been the safe haven. So now all of a sudden the world is panicking because it's worried about Treasuries. And so they buy Treasuries as a safe haven from Treasuries. That's how absurd it is. And I think that, almost like, Wiley Coyote, walking off the side of a cliff, eventually he's going to look down and realize he's not standing on anything. And people who are buying Treasuries because they're afraid of Treasuries, the absurdity of that is going to dawn on some people.
So with the frantic ups, downs, and mixed signals, what's really going on? Sam Andrangi is one of the most up-and-coming fund managers in New York.
Yeah, tell them that there should be no orders outstanding on Liwa right now. Okay, so all of the orders should be taken off.
And because his career got started only a few years before the crash of 2008, he's right at home with this chaotic new order.
I think one of the benefits that younger investors like me have is that we've seen both the great liquidity of sort of the 2004 to 2007 timeframe, as well as the Great Recession. We've seen what it's like when the markets are calm. We've seen what it's like when the markets are in turmoil. I think that gives us a bit of perspective that you don't really know what's happening next, and so all you can really depend on is how your given investments are performing.
Sam founded and runs has.The Capital, a small $20 million fund that has been consistently beating the market since the crash. He doesn't believe the S&P downgrade caused the panic. He says larger forces are at work.
It's a little meaningless for the S&P to give its opinion on whether the U.S. can pay back its debt because the U.S. dollar is the world's reserve currency. Usually when you see governments default, and you have a case like Argentina where it has a lot of foreign currency denominated debt, it has a lot of U.S. dollar denominated debt, and the country doesn't have enough dollars to pay back its debts. That can't happen in the U.S. The dollar is always going to be accepted until the U.S. becomes such a minor player in the world markets that people don't really value the dollar.
has.The Capital specializes in debunking fraudulent Chinese businesses that are preying on American investors. It keeps a watchful eye on China. Sam is concerned that Wall Street is being blown about by a strong easterly wind.
Our perspective is that, it is a potentially troubling time to be in the markets right now, but I don't think it's because of the U.S. debt issue. I think it's because of what's going on in Europe, and I think it's because of potential bubbles in China.
It does seem that only when you look abroad do the fits happening on Wall Street start to make some sense. With a number of European countries on the verge of bankruptcy, with Japan's recent disasters, and with a massive housing bubble developing in China, there may be no other safer place for the big money to go.
With a rating move from AAA to AA+, Treasuries are still the most liquid form of payment in the world. They're the most easy form of collateral in the world. They're readily acceptable. They're in every document as transactionable collateral, and you could liquidate it immediately, and that's not changing.
You see, the real root problem with the global economy is that the world's biggest debtor is issuing the world's reserve currency. That can't be. And all of the global economic imbalances have to do with the overvalued dollar.
So when a Republican-controlled Congress threatened to stop payment on America's debts if the deficit was not slashed, it threw the status of the US dollar as the world's reserve currency into question. That angered America's creditors, especially the Chinese government. who holds more than $1.5 trillion in US Treasuries.
I mean, what happens is that everybody in the world, I mean, particularly the Chinese government, for instance, is holding on to dollars for one reason only, and that is to make the dollar strong. And what that makes the dollar strong, that means that imports to the United States are high and exports from the United States are low. The Chinese government is doing what's good for the Chinese people, and that is making sure that jobs remain or expand in China. But they remain and expand in China at somebody's expense. And this is the workers, for instance, in the United States.
Wall Street has already recovered much of its losses from the last few wild weeks, though the costs have still been high. Tarnished credentials, jobs still scarce, and the effects of the spending cuts yet to be felt. Meanwhile, America's leaders seem unable to stand up, look out to the horizon, and make ready for what may be coming next.